Hello, welcome to the Golden Question. In today's video, we're going to be examining the FOMC's press conference, just the beginning speech that Jerome Powell gives, and I'm going to sort of react to a little bit of his statements. I'm not really taking it that serious, poking fun at some of the stuff that he says. So I hope you guys enjoy.
Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us.
We see here what many have feared before during the Fed's creation, the fear that the Federal Reserve will purely act in Congress's interest at the expense of the American public. Although I think that this task of independency seems impossible to achieve, we see now how investors and the general public are getting used to this, and this mutual benefit between Congress and the Fed are now becoming obvious. The Fed makes sure this bubble keeps going so that it doesn't burst on any politician's watch, while Congress continues to support their monetary policies.
Maximum employment and price stability.
This idea that the Fed can somehow affect employment is completely bogus. All the Fed can do is create inflation, point blank period. The Fed can either print money or not print money. That's the only decision they can make, and that's the only direct effect they have on the economy. How is creating inflation in an economy an attempt to create stability? I never understood how printing trillions of dollars creates stability in an economy.
Since the beginning of the pandemic, we've taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy.
Trust me, you've done enough damage. COVID could have saved this economy, actually, by ending this spending mania that has been in existence since your creation. What you need to do now is stop the damage you've already done and attempt to deflate this bubble that you've created.
Today, my colleagues on the FOMC and I reaffirmed our strong forward guidance for interest rates.
By forward guidance, he means tell people that interest rates will stay low for an extended period of time and make them believe that before he actually lowers interest rates. He's already at zero. The only thing he can continue doing is telling people that they're going to be at zero for a prolonged period of time. Of course, inflation will make interest rates really negative, but he cannot tell people that. He cannot tell people that the banks are actively stealing their depositors' savings. He needs to do it over time so that people can't tell that they're being robbed of their wealth. Real rates are much harder to detect than nominal rates.
And also provided additional guidance for our asset purchases.
Asset purchases? The Federal Reserve is buying assets? Let me look at their balance sheet. Wow. $7 trillion. That's a lot of assets. That means they could be owning my home, my car. Name any debt, they own it.
Together, these measures will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete.
Right. So you buying assets and encouraging people, businesses, and governments to go deeper into debt will make things get better and the recovery happen. Oh yeah, debt makes everything better. I forgot.
Economic activity has continued to recover from its depressed second quarter level. The substantial reopening of the economy.
The Fed is kind of scared of the economy opening as fast as we want it to. Given that they've printed all these dollars, making the inflation that they've created that more obvious is kind of scary for them.
Led to a rapid rebound in activity, and real GDP rose at an annual rate of 33% in the third quarter.
Also, GDP rose, but how much of that is contributed to the money printing? Fed prints money, people get money, people go out and spend. Obviously, GDP is going to rise.
The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our September Summary of Economic Projections.
Ladies and gentlemen, that is all inflation.
Participation in the labor market remains notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, we will not lose sight of the millions of Americans who remain out of work.
Why would you? They're at home enjoying their free income, watching some TV, watching some Netflix. They're making more at home than they would have working, and they're not working. Who here is wanting to go back to work and make less money than they are now while they are unemployed? Not me.
Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 5% at the end of next year and moves below 4% by 2023.
Yes, more and more lousy part-time jobs that nobody wants.
The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics.
Ah, yes. Gotta mention African Americans and Hispanics in connection to lower wage workers, of course.
The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation.
Look at that large gulp after he mentions inflation.
Following large declines in the spring, consumer prices picked up over the summer, but have leveled out more recently. For those sectors that have been most adversely affected by the pandemic, prices remain particularly soft.
Who refers to prices as being soft? Never heard that one before.
Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.8% next year, and reaches 2% in 2023. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on the course of the virus.
You know what I'm starting to think? The more these lockdowns prolong, the more money the Fed can print, and the more time they have before this money gets back into the economy and into circulation. Thus, the inflation becomes not obvious.
As we previously announced, we are now releasing the entire package of our SEP materials at the same time as our FOMC statement. Included in these materials are two new exhibits that show how the balance of participants' assessments of uncertainty and risks have evolved over time. Since the onset of the pandemic, nearly all participants continue to judge the level of uncertainty about the economic outlook as elevated. In terms of risks to the outlook, fewer participants see the balance of risks as weighted to the downside than in September. While a little more than half of participants now judge risks to be broadly balanced for economic activity, a similar number continue to see risks weighted to the downside for inflation.
You know, I never really understood these risk assessments. Why would the Fed ever admit to the economic environment as being risky, while also simultaneously trying to maintain stability? It just doesn't make any sense. It's obviously some sort of propaganda ploy. It's sort of like letting the mafia run crime statistics in their own neighborhood. It just doesn't make any sense.
The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As noted in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal.
We've heard this a million times. Their actions don't match their words.
Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%.
What they're basically saying is, don't worry about the money printing we're doing. It's not causing any inflation. In fact, there's not enough inflation. I love how over the course of US history, inflation went from something bad to something good.
As we reiterated in today's statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved.
As stated before, the only thing the Fed can do is print money. That is the only effect that can have on the economy is whether or not there will or will not be inflation. So we can largely ignore any claims they have regarding employment, which is beyond the scope of their direct control.
With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
We're going to continue to print more money.
In addition, as we noted in today's policy statement, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals.
We're going to keep monetizing government debt, and we're going to keep buying mortgages to continue drowning as much people as possible in debt.
We believe the increase in our balance sheet this year has materially eased financial conditions and is providing substantial support to the economy.
You've been supporting this economy for way too long. Why not just let it live its own life? Let it walk on its own. Let it live the life that it ever so wants and deserves.
Combined with our forward guidance for the federal funds rate, our enhanced balance sheet guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and is tied to progress toward reaching our employment and inflation goals. Thus, if progress toward our goals were to slow, the guidance would convey our intention to increase policy accommodation through a lower expected path of the federal funds rate and a higher expected path of the balance sheet.
They always have to mention inflation and employment together. Of course, to imply that since employment is good, therefore inflation must be as well.
Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so.
We are going to continue to drug up this economy with debt.
The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments.
We are going to indebt households, businesses large and small, and state and local governments as much as possible.
Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery.
Something a drug dealer would say to their client, just substitute the word economy for a person.
Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today.
A virus is a virus, and viruses have hit us before and will continue to hit us in the future. Yes, this is an emergency, but everything you do is a result of an emergency. But emergencies are normal. And this may happen, that may happen, nobody can predict it. Part of having a strong economy is being able to mitigate these emergencies. By you saying that the Fed needs to step in every time there is an emergency, you are effectively implying that the market is unreliable, unstable in that sense, unable to adapt, unable to correct, and frankly, undermining the whole idea of capitalism and the free market.
These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury.
We have printed money at an unprecedented level.
Although funds from the CARES Act will not be available to support new loans or new purchases of assets after December 31, the Treasury could authorize support for emerging lending facilities if needed through the Exchange Stabilization Fund.
All these fancy names for programs that are designed all to do the same thing. Print, and print more and more money.
When the time comes, after the crisis has passed, we will put these emergency tools back in the box.
Until we take them out once another emergency arises. I really want to know what the Fed defines as an emergency. They went from '08 doing it, saying that they'll never do it before, not mentioning that an emergency could arise in the future where they might have to pull out these tools. And now that the second emergency has come, they can't say they won't never do it again, so now they resort to saying, well, we're going to put them back until, of course, another emergency arises where we're going to have to pull them out and do the same exact thing that we've done at that time for the third time in a row.
As I have emphasized before, these are lending powers, not spending powers.
Huh? Oh my gosh. Cannot believe he just said that with a straight face.
The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid.
So you really think someone is going to pay you back $7 trillion? Nope. Just sounds like free money to me.
Many borrowers are benefiting from these programs, as is the overall economy.
People going deeper into debt are benefiting in this crisis.
But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country.
To be honest, fiscal and monetary policy have really morphed into one thing. The government spends money that the Fed prints.
Even so, the current economic downturn is the most severe of our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. To conclude, we understand that our actions affect communities, families, and businesses across the country.
We have negatively affected the poor while positively affecting the rich.
Everything we do is in service to our public mission.
Everything you did has been in service to the rich, of course, by inflating their asset prices, and the government by expanding their power and control.
We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible.
If this recovery is going to be robust, are you sure that you won't be able to pull out those tools in the future? If you create a robust recovery, you're implying that it can mitigate and take some of the future damages, let's say. But if every time an emergency arises, you come out and you pull out these tools and you'll say that you'll only be using them during times of emergency, how do we know they're working? How do we know they're not just weakening the economy, temporarily making it seem better, but in fact weakening it to the point where it becomes vulnerable to future emergencies? This creates sort of like the failure in the falsifiability test. There's no way we can prove that the Fed's policies work because every time they look like they're not working, they claim that they just need to do more. It's like punching someone in the face hoping that they'll get better, and then once they feel hurt, they say, "Oh no, we haven't punched you hard enough."
Thank you. I'll look forward to your questions.
Again, folks, what we see here is central planning run amok. Hey, we're going to help the economy. Let's pull out these tools. All right, we're all good now. Oh, we need to pull them out again? Oh, I guess we didn't do enough. Let's do it again. And again. And again. What this does is it undermines the overall economy. The economy becomes addicted to their aid and help, which, as we are witnessing before our own eyes, only makes the economy that much worse. If our economy was as strong as they claimed it was, it would have been able to weather the storm. But it didn't. We right back came pleading for their help. We are weak and frankly vulnerable. They've weakened us and put us into a position where we are continuously returning back for their help. Like a doctor slowly poisoning his patient so that he can return back asking for more help. Smart, isn't it?